Hi, everyone. This is Jason Burek of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. He has over 30 years of experience managing money in the securities industry. He's the founder of Deep Knowledge Investing and a former managing partner and senior portfolio manager for Silver Arrow Investment Management, a concentrated long-only hedge fund. Gary Brode, thank you for joining me again.
Thanks, Jason. Good to be here. I appreciate you inviting me.
So, Gary, we're recording this interview on Thursday, June 27th, 2024. The dollar index is at 105.93. The 10-year US Treasury yield, it's been a roller coaster for the last 6 to 9 months. It's kind of rallying a little bit. It's up to 4.288%, got as low as, I think, below 4.2% last week or so. I want to get your thoughts on the yen carry trade and the Japanese yen being at a 38-year low against the dollar. You've been writing about the yen carry trade unwind for over 12 months now. How do you think a weak Japanese yen and the problems that we're seeing in the news headlines with this fifth largest Japanese bank, how do you think that plays into the yen carry trade unwind?
So it's a great question, Jason. And Japan, they've got some huge problems. The asset they have on the other side of that problem is a lot of foreign currency reserves. And in this case, they own a huge number of US Treasury bonds. And so, maybe we should explain to people what the carry trade is, although, they've probably heard it on your show before. But basically, what people have done is they've said, okay, wait a minute, the Bank of Japan has kept interest rates exceedingly low for a really long time. In fact, I think for 9 years, interest rates there were negative. And the yield on the 10-year was trading at something like 25 basis points for years and years. And so what people would do is they would short the yen, and it would cost them, like 25 basis points to do it. And they would buy US Treasuries, like maybe the 10-year, which you were talking about at 4.2%, and they would capture the spread. And as long as the currency trade didn't go against them too badly, they pretty much had a guaranteed return. And so you had huge, huge amounts of money that was short Japanese government bonds or short the yen and long US Treasuries or long the dollar. And so, Japan, they have a huge problem right now with their budget, with their debt, with their interest rates. The yen is plummeting, as you talked about. And ultimately, the Bank of Japan, I believe, is going to have to increase interest rates. They just can't be, 400, 500 basis points below the rest of the world and expect the yen to not implode. And that's a problem for everyone, but it's particularly a problem for Japan. While they have a very strong economy, it's a small island nation that has to import a lot, including energy. And energy is typically priced in US dollars. And when your currency is slid from, I think a couple of years ago, something like 102, 103 yen to the dollar, to now it's about 161 to the dollar, that's making energy and other things in Japan much more expensive. And so when the Bank of Japan increases interest rates, which again, I think they're going to need to do, that's going to collapse the spread on the carry trade. The difference in the yield between the US Treasuries and the Japanese government bonds is going to decrease. And that's going to make the carry trade less attractive. And when that money starts flowing out, and we're talking huge amounts of money here, I expect what will happen is enough selling of US Treasury bonds will lead to higher yields here. And that's not great for our budget, especially given the fact that we're printing an extra 2, 3+ trillion a year to pay for our expenses now. And so if the rate on our debt goes up, we're going to have higher interest expense, higher budget deficits. And guess what, Jason? The only way out of that is to print more dollars to pay for it. And then we end up with the inflation here. Basically, Japan has had a huge amount of inflation because the yen has been weak against the dollar. Well, if they raise rates and start to reverse the carry trade, that's going to be returned in our direction.
Now, does the weak yen and the stuff you explained about the carry trade, are all of these large Japanese banks, including the fifth largest Japanese bank where the headlines occurred last week, are they also participating in funding the yen carry trade? So have the Japanese banks, because you've been a hedge fund manager for a very long time in the past, were a lot of hedge fund managers and bank portfolio managers in the US and Europe, were they borrowing the funds from the Japanese banks to go do the yen carry trade? So all the Japanese banks were the main funders of the carry trade?
You know what? That's a great question. I actually don't know the answer. What I do know is that I think it was last year for the entire summer, the only buyer of Japanese bonds it was the Bank of Japan. And there were weeks when they were the only people trading it. The question is, if they were buying all of that, were they the other side of short trades for US hedge funds, or did that go through other Japanese banks? And the truth is, I'm not sure on that. You did allude to something else that I think is really important. If we go back just over a year ago, I think at this point, maybe 15 months or so, we had several banks here in the US, including Silicon Valley Bank and First Republic, go under. And the reason that a few banks last year failed here is because they had losses in their bond portfolio. Basically, they were long duration. And when interest rates went up, they basically had short-term liabilities and long-term assets. And so they got crushed. They got crushed on that spread, and their bond portfolios went underwater. And, when people started to withdraw assets, when they started to withdraw cash from those banks, they were forced to sell their bonds at a loss. Now, people have correctly pointed out that if you hold those bonds to maturity, you don't take any losses. The problem is that when the offset to that are demand accounts, where bank customers can come in, demand the money in their checking account or their savings account on a particular day, they had to realize those losses. And I think, what you're alluding to, and if you're saying what I think you are, I agree with you. I think Japanese banks may be about to be in the same kind of position where if the Bank of Japan raises interest rates, it can cause losses in their bank's bond portfolios.
Well, it also sounds like the Japanese banks own a very large percentage of US Treasuries. And so it sounded, when I was reading the press release and the articles about the Japanese bank last week, sounded like very similar to Silicon Valley Bank, except this is a foreign bank and they don't have the Federal Reserve Bank to send them like digital dollars.
Right. That's a terrific point. And, it'll be interesting to see what happens in a place like Japan, where historically there's been a lot of cross holdings, and, the government and other corporations have preferred not to see their, sister corporations go under. But it'll be interesting to see what happens if the banks there start to end up with huge losses. And, by the way, the Bank of Japan may have the same thing. And if you're right that those banks own a lot of US Treasuries, again, if the Bank of Japan raises rates, that ends up with more selling of the dollar as the carry trade unwinds, potentially higher rates here, and they could end up taking losses on their US bonds as well.
And this Japanese
there's a situation where the yield on both the Japanese government bonds and US Treasuries go up at the same time.
And that's bad for banks, so that's losses on all their bonds.
Anything they've got that's long term, right? So the issue with banks, what they typically will do is so normally the yield curve is steep. It goes up over time. So if you're borrowing money for a day, the interest rate will be very low. If you're borrowing money for a year, the interest rate will be a little higher. For 10 years, it'll be higher. For 30 years, it'll be much higher. And so that's what, when we talk about a normal yield curve, that's what we're referring to. And so what banks will typically do is they'll borrow short term. And, we all just came off of years and years and years when nobody got anything in their savings and checking accounts, right? Jason, you remember getting like 0.02%?
Yeah.
You'd get your checking statement or your account statement, and you would have earned like 50 cents in interest or a few dollars or $30, however much money you have in the account. Is like some ridiculously small amount of money. So I think what banks will typically do is they will borrow money very short term and pay low rates on that. And then they'll lend money medium to long term, and they'll receive higher rates on that, and they'll capture a spread, which people refer to as the net interest margin. And under normal circumstances, that works pretty well, right? The banking business has been a pretty good business for hundreds and hundreds of years. But in situations where the yield curve changes shape quickly or rates will rise quickly, that will affect long duration assets more significantly than short duration assets. And so, they'll end up paying more on the checking accounts, which is more money out, but they can take huge losses in the bond portfolio because it's harder to roll that over faster. You can't change the duration on that without realizing the losses. Does that make sense?
Yes, it makes a lot of sense. But then you add in fractional reserve banking, and when interest rates were low, you had a lot of bond portfolio managers at these Wall Street banks, and they started to put on these hedge fund trades like the risk parity trade, the basis trade, the leverage short volatility trade, all these leverage trades. They're gambling in derivatives. The last rate hiking cycle from the Fed with Jerome Powell, that caused the repo crisis in 2019 because so many hedge funds and bank portfolio managers were desperate for yield. They put on the leverage risk parity trade, and then the Fed was raising interest rates and they couldn't pay back the loans that they borrowed from the repo market to put on their leverage bond trades.
So normally, I'm not a big fan of populist movements, but the situation that you just described is one of those situations when I 100% agree with the populists. And the reason people get so upset is because what you've described is exactly what happens. These banks are making a certain amount of money, right? And they have the advantage of fractional reserve banking, which gives them access to a lot of leverage. They have access to the Fed window, they have access to discount financing, and they have their net interest margin. And then what they'll do is, like you said, when times are good, they say, oh, wait, if we use more leverage and take more risk and start to dip into these other products or, take a little more duration risk, we can make more money. And it's exactly what you said. They basically run like bond hedge funds, is pretty much the way they do it. And when things are working out, they make a lot more money. And that's great for the banks. It's great for their shareholders. Terrific. But when it doesn't work, it all goes badly very, very quickly. So quickly that they don't have time to adjust. Or in the case of like First Republic or Silicon Valley, they had time to adjust. They chose not to. They basically put their blindfolds on, kept their fingers crossed, and said, maybe it'll go away if we ignore it. And that didn't happen. And so when these things happen here in the US, we've tended to have bank bailouts. And that's why people get so angry. That's why they talk about, if things are going well, it's capitalism for the banks. If things are going poorly, oh, it's socialism. We have to save the system. And so, like I said, normally I'm not a fan of these populist movements, but in this case, I am 100% on board with the people who are screaming about this because if you're going to take that kind of excessive risk in the pursuit of greater profits, terrific, and you get the upside, the benefit of pursuing those kinds of risky investments, which, great, they're entitled to do it. But if it doesn't work out, those losses should fall on the banks and their shareholders. The equity should be wiped out, and these things should be salted and gone from the earth. And that's not what we have here, right? We have a situation where when the banks are making a lot of money, their stocks go up. When they lose a lot of money, the government steps in. And that absolutely needs to stop. And the problem here is every time they do this, every time we do another round of this, it takes more money to save the system. The system becomes more leveraged, and we end up with this ridiculous moniker, too big to fail. That is absolutely not a thing. And if we have a system where banks can take excessive risk, and if them failing crashes the entire economy, then they shouldn't be allowed to do that. Or then we just need to live with the fact that we're going to have some big banks that crash and fail. But the situation where the government keeps bailing them out, people are angry for a reason. And this is one of the situations where I agree with them.
We're not having real free market capitalism too, because they're not allowing actual bankruptcies. Maybe a few small banks here or there, or the FDIC merges, does a shotgun wedding for some small regional banks, but they're not allowing sizable banks to fail. So like you said, the shareholders are not getting wiped out because they're worried about another Bear Stearns or Lehman Brothers or Credit Suisse. So the governments and the central banks are stepping in with all kinds of rules changes, goalpost moving, secret bailouts. I don't know if you saw the written documents in exchange that UBS got for merging with Credit Suisse. I mean, there was a ton of guarantees in there from the Swiss government and the Swiss taxpayer.
Yeah, those kinds of deals are just sweetheart deals. And so, the surviving bank will buy the failing bank at a discount, and there will be government subsidies and government guarantees. And like you talked about, nobody sees how bad it really is. And because there's so little accurate government accounting, or the amounts are just so enormous, nobody really knows how big the bailouts are and how much assistance some of these corporations are receiving. But you're right. It is not a capitalist system. The one thing that I think is horrendous is, like, Jason, I know you understand better than anybody else that all governments want to grow. They all want to grab power. The people who are there want more power for themselves. They want more assets. They want a greater sphere of influence. And we don't have the only corrupt government in the world. It's like that everywhere. And so I actually think the US government is fine with a bunch of small and medium-sized banks failing. They would prefer, I think most of Washington, D.C. would prefer about half a dozen mega banks that are basically co-opted by the government. At that size, they're too big to fail and they're basically permanent government partners. And that gives the government a whole lot of control, right? Imagine, if you say, we don't want anybody lending to companies engaging in this kind of business or that kind of business. Maybe it's oil and gas investing, or maybe it's firearms, whatever it is that is unattractive today. Maybe it's cannabis. Whatever it is that people are saying, we don't like this today, this is icky. Imagine being in the US government and being able to call 6 bank CEOs. You make 6 phone calls and say, hey guys, if you want to continue living off of government largesse or ensure that you'll have access to the next bailout, just don't extend credit to anybody with these QSIP numbers or in these industries. It becomes a situation too big to fail without other banks that could fail, becomes a situation where the government basically controls the banking sector. And if that's the case, they control credit to the entire economy.
Well, who else is going to buy the US Treasuries at this point? It's not going to be China or Japan.
Yeah, I was going to say we're losing the Bank of Japan as a huge buyer. One thing that's really interesting, we just did a chart on this. We've got a weekly piece called 5 Things to Know in Investing this week. And we actually just produced a chart on that. And it turns out that foreign purchases of US Treasury securities have been flat. And, you're right. China and Japan, they've curtailed purchases. There are, this whole BRICS movement, which a lot of people don't take seriously, but at a minimum, Jason, more than half the people on the planet live in countries that are trying to either de-dollarize or reduce their exposure to the dollar. And so, there's all of this going on, and all of these countries and central banks are putting less money into the dollar as a reserve currency. The dollar is losing share as the reserve currency. But foreign purchases of treasury bills and treasury bonds hasn't gone down. And so we looked at it. It turns out that it's citizens of foreign countries. So the BRICS countries are saying, their central banks and their governments are saying, we don't want to hold dollars, but their citizens do. And so far, we have not suffered. By we, I mean the United States. We haven't suffered from the aversion to treasury bills in some of these large central banks and our partner governments and economies that we do business with, because their citizens have been buying treasuries. And that's made up the difference.
Well, I think it's a relative inflation rate too, because the other currencies are so weak against the dollar. You can see that with the dollar index, but also a lot of weakness in other foreign emerging market economies. So the people on the streets in those other countries, if you're in Argentina and you've had a 200% annual inflation rate for many years, the US dollar or 5% or close to 5% yield on US Treasuries is short-term ones is looking very attractive relative to holding your savings in Argentinian pesos. So I think that's what's happening.
I think that's a fantastic point. And in fact, I spent the entire month of February, not this past winter, the winter before, in Buenos Aires. I have a wonderful friend there, and I visited, and I just like to go live and work in other countries for a while. And when I got there, I think the official dollar exchange rate was something like 180 pesos to the dollar. I'm doing this from memory. But the blue market rate, don't ask me why they call it the blue market rate, but it's here what we would call the black market, is something like 280, or was 280 pesos to the dollar. And then later that year, it blew out to close to 1,000 pesos to the dollar. And so Argentinians spend an enormous amount of time and energy and intellectual effort immediately converting their pesos into anything else. Typically dollars, if they can get them. When they can't, they're using Bitcoin at an increasing rate or hard assets. But the last thing they want to do is hold pesos. Obviously, this is before Milei, but you can't save in pesos because they depreciate so quickly. In fact, I met somebody there who was telling me about her effort to rent an apartment, and I think she wanted to sign something like a 2 or 3 year lease, which to me seems like a reasonable, normal thing to do. but she could only get the rent guaranteed for 6 months. And nobody would guarantee a rate on the rent for longer than 6 months because they had no idea what the peso was going to be worth. So try to imagine, Jason, if you were working in Buenos Aires and, imagine you go to work for a bank or a consulting firm or, a media company there, and you get paid a certain salary. And you then sign a lease, and that you may have a 3-year lease, but you're only locked in on your rent for 6 months. And, all of a sudden you've got your fingers crossed that how much you get paid will match what your rent is just 6 months down the road. And these things can change so quickly and are so nebulous. It can be very difficult to do any kind of planning. And you know what? Let me just insert one other thing here. Forget the thing that Americans think about, which is, how do we save to buy a house? That's just not possible there. But imagine something really simple. Imagine that, you're married and you have a kid, you have 2 kids, something like that. And you think, okay, I have 18 years or so to save for this kid's college education. So, Jason, how would you do that? How do you save? How do you do that if you're in Argentina? And it's hard to get dollars. But you have no idea what those pesos are going to be worth in 18 years. You have no idea what they're going to be worth in 18 months.
Well, you're going to see people buy hard assets like commodities, real estate. They're going to want to invest. I think this is why you're seeing a lot of flow of funds out from emerging markets, China, other countries, and into like the Mag 7 and Nvidia. It seems very similar to the flow of funds, fly capital out of those countries into our stock market. Prior to the October 1987 crash, I just saw comments from Stanley Druckenmiller talking about what led up to the 1987 stock market crash, or the year or two before the October 1929 crash. I mean, there was boom times. You're seeing on business television now, they're bringing out all these experts. Oh, there's a new bull market. The stock market's the breadth of all the other companies is gonna widen out, but it's really the concentration, the stock market. It's only been 4 or 5 companies that have driven most of the S&P 500 gains this year.
Yeah, I mean, last year people were talking about the Magnificent Seven, and then that got whittled down to the Magnificent Five, or whatever, the Fantastic Five, and then we were down to the Terminal Two, and this year has pretty much been the only one, right? And Nvidia has led the market and been responsible for a huge percentage of market gains. Michael Guyot has talked a lot about market breadth, and when people talk about the market being up, he points out that for most companies, they're nowhere near their all-time highs. And I also agree with you about the importance of saving in hard assets, right? By the way, I no longer save in dollars at all. I own enough dollars to pay my bills, to pay my mortgage. That's it. Everything else that isn't in individual stocks that I like is in things like gold, a little bit of silver, a lot of Bitcoin, a lot of energy, uranium. I'm thinking about things that will hold purchasing power as the purchasing power of the dollar falls. And, you were talking before about, the dollar index, about Dixie, DXY. And it's a debate I've been having with people for a couple of years. And every time I talk to people who think about the world like foreign exchange traders, they talk about the strong dollar. And that's true if you want to buy euros or yen or, British pounds. Then it's true. The dollar has been very strong as the US Federal Reserve has been more aggressive in raising rates than other central banks. And so that has led to dollar strength. And, paradoxically, the worse things get, there's this flight to safety. And right or wrong, the dollar is viewed as right now, the safest asset in that particular class. But if you're an American citizen and you want to buy things like food, fuel, you want to rent a house, you want to buy a house, anything like that. Even everybody's talking about fast food prices. The dollar's losing purchasing power pretty rapidly. And it's been my belief for years that the CPI is understated. So when people now talk about inflation at 3%, 4%, 3.5%, I don't think that's accurate. I don't think that most people are experiencing inflation that low. And so, I think the point that you're making, which is people should be thinking about hard assets, I completely agree with hard assets and individual stocks. But I'm not holding dollars right now.
Did you see the comments that Janet Yellen made about grocery shopping? I'm guessing she hasn't done her grocery shopping in many, many years.
Here's the amazing thing to me, Jason. I I saw that. And by the way, that is going to lead off next week's five things. I shout out to our new intern, Alex, who today put together a hilarious graphic of Janet Yellen and Marie Antoinette in a supermarket and, holding a cake, right? It's the let them eat cake thing. And he did a great job with it. And it's really funny. And so we're leading off next week's five things with that, talking about Yellen's comments. And, for people who haven't seen it, Janet Yellen, former chairperson of the Federal Reserve, current Secretary of the Treasury, basically was saying that food inflation isn't very high and grocery bills aren't up a lot, which is something that 99% of actual Americans who do their own grocery shopping would contest. And, worth pointing out, Yellen is worth tens of millions of dollars. So maybe she doesn't notice when her grocery bill goes up 20% or 30% or 50%. Jason, to me, the weird thing is I can understand why Yellen doesn't think that food prices are up a lot, right? If you're worth tens of millions of dollars, it probably doesn't matter to you if your weekly grocery bill is $100 or $200 or $500, right? To most Americans, it would matter.
I agree with you. She's also a labor economist, so she has a PhD, and her specific type of economics is labor economist. So unfortunately, they believe that stagflation should not exist because of the Phillips curve.
Yeah, well, there's a problem when your academic theories conflict with reality, and you say, "No, I'm going to stick with my academic theory." Like it's like Taleb's black swan thing. Right? You're staring at the thing that you say doesn't exist, but you're staring at it and you're saying, no, that's not a black swan. Yes, it is. It happens infrequently, but it does happen. The thing that surprises me, it doesn't surprise me so much that Yellen doesn't know this. What surprises me is that anybody who's spent that much time in Washington would be foolish enough to say it out loud. Right? I mean, if you have spent decades in Washington, how would you be dumb enough to get in front of a camera or on a recording or in front of a reporter and tell people who are saying we can't afford our groceries, our food bills are up? No, I don't think that's true. I don't think, prices are up very much. Prices have been stable. Like it's insulting. It's insulting to people. And the thing that shocks me isn't that she believes it. It's that she was foolish enough to say it out loud.
Well, they believe a lot of stuff. I mean, they point to like the consumer price index, which I call the CPI or the changing propaganda index. But I mean, things are getting so desperate, Gary, now in DC. You have Jerome Powell during a press conference, and he's calling out the Biden administration for fake jobs numbers. I did not think I would see one government employee, an unelected bureaucrat, chairman of the Federal Reserve, because it's not like American taxpayers are voting for him in there, calling out another about fake economic data.
So, by the way, like you, I have been critical of Jerome Powell and the Federal Reserve. I've been on Team End the Fed for years. But last week, the week before, I actually gave Powell a round of applause because he did something that is increasingly rare in Washington. He told the truth in public. And not only did he say the things that you were talking about, but during his press conference after the last Fed meeting, somebody was asking him about a change in projections. And basically, while the Fed is saying we're going to get inflation under control, they were projecting one measure of inflation to be higher at the end of this year than it was in the prior month. And somebody said, wait a minute, this doesn't match. And Powell said, okay, part of it is the comparison. We have tougher comparisons in the second half of the year. And he's right. Looking at the timing of these things, like the 2-year comp, actually does matter. But then he told the truth. He said, we don't have a lot of confidence in our models. And I'm like, well, good for you, Jerome, because I got news for you. I don't have confidence in your projections either. So, let's give him credit for telling the truth in public. People don't often do that. And for the chairman of the Federal Reserve, kidding aside, for the chairman of the Federal Reserve to say our projections, only have so much validity, like he's actually right. And that's part of the problem with the system. It's not so much that I think the people at the Fed are foolish or dumb. It's more a matter of they shouldn't have that kind of power or control. A group of, a dozen or 2 dozen unelected bureaucrats shouldn't be controlling the most important numbers, the most important metrics in the economy. It's the price of risk and time. That should be set by the market. And Powell's right. They can't project, and we've run these numbers. I mean, literally anywhere from 6 to 18 months out, the Fed can't predict the Fed funds rate, right? We've run the charts on this. Their projections of the Fed funds rate are comically inaccurate as little as 6 to 18 months out. And that's the thing they control, right? They literally can't project or predict the thing that they control. And so I agree. They can't. They don't know what it's going to be. We should stop pretending that this group of, 17 or so unelected bureaucrats in Washington or, anywhere in the country, I realize they're all over, that they can direct and control and, fly the economy. They can't, and we should just stop trying to do it. But to the extent that my dream for no longer having a Federal Reserve has a 0% probability of coming true, let's at least credit Powell for telling the truth about it and saying, yeah, we've got no idea what we're doing.
Well, I think behind the scenes, and you're starting to see this with the announcement of the US Treasury buyback program, which they are implementing at a small amount, but for the first time since the 1990s, you're seeing a supply and demand situation develop, a serious one for US Treasury market with the current yield, interest payments on the debt, and then the lack of foreign demand. The central banks are not reinvesting the trade surpluses of foreign exchange reserves into buying the US Treasuries. So that's going to put pressure on who's going to buy the Treasuries. Is it going to be the Federal Reserve Bank with expanding its balance sheet again, the US Treasury off balance sheet, or are they just going to stuff the treasuries then into the banking system, and then that's going to expand the M2 money supply, and then that's going to be inflationary too in the long run?
That's a great point, Jason. And on that I actually I'm going to come back to Treasury Secretary Janet Yellen again on this. She's been doing something that I think is really dangerous. And in order to try to reduce the borrowing costs of the US government, what she's done is she's shortened the duration of the treasury auction. So, for people who are new to this, there are treasury auctions, pretty much every week. And they're of different sizes depending on, where in the month you are or where in the year you are. But what Yellen has been doing is as she's been refinancing the debt that rolls over, she's been refinancing that debt for a shorter and shorter period of time. And what happens is, so Jason, imagine for a minute, we've got a whole bunch of 10-year debt and, that's rolling over. And instead of rolling that over into more 10-year treasuries, we start to roll that over into 1-year treasuries. Well, what that means is you need to refinance that debt 10 times more often. And what that means is your auctions will get larger and larger. And that's what we're seeing. And so at a point where there may be, as you pointed out, decreasing demand for US Treasuries, the way Yellen is handling things means that because the debt is rolling over more frequently, the size of those auctions are going to increase. And we've seen a bunch of auctions this year with 4 and 5 basis point tails. And what that means is to have that negative tail that, even if it's just a few basis points, it means there was less demand in that auction than there was supply. And that means the government had to cut the price of the bonds. And so you think, okay, well, it's 5 basis points a lot. Well, it turns out it actually is. It indicates a huge imbalance between supply and demand, and situations where the government has had to cut pricing at the last minute to get the auction done historically have been relatively rare. Or when it happened, it was just tiny. And these tails are getting more frequent and larger. And it's because of the way Yellen's handling this. Now, what I'm about to say, I don't know for sure, but I suspect the reason she's doing it is she's hoping that Powell will lower rates. And, one of the things I've written about a lot in the last couple of years is there's this quiet war going on between Powell and the Fed on one hand, who's trying to get inflation under control, and the White House and Congress and the Treasury Department on the other hand, which is basically pouring massive amounts of stimulus into the economy, pretending inflation doesn't exist. And, the Treasury Department's monetizing all this. And so as Powell is trying to get inflation under control, Congress, the White House, and the Treasury are undoing that at the same time. And so these guys, their policies are at odds with each other. And somebody in the last press conference asked Powell about that. And I thought it was really interesting. Like there was an insightful question by the reporter, and he basically said, look, we have no control over Congress. We don't, we don't change monetary policy to accommodate them. But I think that was basically him acknowledging, yeah, look, we're pulling, they're pushing, we're heading in different directions, and this is just going to happen. We can't control them, they can't control us. So, we'll see where we end up. And so, Yellen's making a bet, I think, that Powell will blink, and I don't know that he will.
Well, not until something breaks, but I think we're starting to see the rest of the G7. They're starting to cut rates. So the Swiss National Bank, I think, cut rates once or twice recently. The European Central Bank cut interest rates for the first time since 2019. The Bank of Canada also cut rates. And the traders are now betting that there's a very high probability that the Bank of England will cut rates for the first time, I think, in a couple years. I think in August. So the rest of the G7, the Fed's not cutting rates, like you said. For the currency traders, the dollar will stay relatively strong. But the other G7 central banks, they're going to be cutting interest rates. That means more liquidity, doesn't it? That could go into asset markets.
It definitely does. And the situation in Canada, I found fascinating. By the way, you should have written this week's 5 things. Everything you're talking about, we're writing tomorrow for release next week. But the situation in Canada is fascinating because they didn't learn the Arthur Burns problem. So, for people who aren't, huge fans of economic history, and I can understand why, that's not what you're reading in bed at night. Arthur Burns was the chairman of the Federal Reserve in the United States back in the 1970s. And inflation actually started to perk up in the US back in the 60s. And so Burns raised rates. That was the prescription to handle it. And inflation started to come down. And what Burns should have done is he should have held firm, right? He should have been saying higher for longer. But Lyndon Johnson intimidated him and pushed him around. And, Johnson, like every president of any party, wanted more stimulus and a hotter economy. And, the story is that he literally slammed Burns against the wall. And, if you're 6'4", 6'5", Lyndon Johnson, and you're the president, I guess you get to do stuff like that. I wouldn't advise it. And Burns blinked and he lowered interest rates and inflation came roaring back. And we ended up with, this horrible inflation back in the late 1970s. It killed the Carter presidency. And, that's when Paul Volcker, who was then took over the Federal Reserve, raised interest rates to right around 20%. And it killed the economy, but got inflation under control. And, here in the US, we can't have that again because the debt is so enormous right now. We're not going to get anywhere close to that. Well, what Canada just did was they just lowered rates and they were expecting their version of the CPI, their inflation metric, to come in at around, I think, 2.6%. And it came in at 2.9%. So basically, 15 minutes after they lowered rates, inflation started to perk up again. And that's why Powell, you're talking about he's going to hold on until something breaks. This is the reason. And to the extent that he was about to lose his nerve, Canada has just given us the Arthur Burns story again, because apparently nobody can remember what happened 50 years ago. But, these things go in cycles. And, Canada just made a huge error on this and they're going to pay for it. And so, look, I hope Powell is watching that. It's my belief that Powell wants to be the next Paul Volcker. It's my belief that he's terrified of being the next Arthur Burns. So when he says higher for longer, I actually think he means it, because you can survive as the Fed chair if you throw the country into a recession. Right? You'll survive that. But if you're the author of a double dip inflationary spike and we end up with double digit inflation again, even if it's measured, like you said, the CPI, or what was the criminal price index? What did you call it?
I call it changing propaganda index, because honestly, it sounds a lot like this former Soviet Union, what used to happen there with their PhD economists, the economic propaganda department.
Yeah. And by the way, I've got a story for you on that. But I think if Powell can survive a recession, But if we end up with a CPI around 10% again, he will go down in history as a villain. He'll be despised. I don't think he wants that. One of the things that is really interesting because your comparison to, the Soviet economists who basically made up numbers is fascinating and dead on. Somebody who's on the Deep Knowledge Investing Board of Advisors is Dr. John Lanchowski, who was President Reagan's national security advisor on the then Soviet Union. And he was one of the great minds who helped win the Cold War without firing a shot. And the Soviet economic data was so misleading that the US government at the time thought the Soviets were spending about 15% of their GDP on defense. And what President Reagan did was he basically outspent them. And the reason it worked was because it turns out that the Soviet Union wasn't spending 15% of their GDP on defense. It was more like 40 to 60%. And
Yeah.
they couldn't match. And the whole thing fell apart. And so the danger of having your economic data be propaganda or lies is you start to believe that data yourself. And again, we're back to the point I was making before, which is what happens when your academic theories don't match reality and you refuse to acknowledge reality. At some point, things collapse like the Soviet Union did.
Yeah, I agree. The Soviet Union, their real economy was way, way smaller. And like you said, they were spending so much on military and defense, but their central planning for their real economy was terrible. So there was no real economy in the Soviet Union for the most part. I mean, there was no potential for upward mobility. There was tons of corruption. They did tons of currency debasement and taxes and stuff like that. So there wasn't any private property or ownership, and the real economy was nowhere near. It was basically the whole economy was more or less military and Potemkin villages.
So on that, one of my favorite stories, which I think beautifully explains why command economies don't work. People, all these people who are supposedly smart, they all think, well, if we just have, enough really smart PhD experts running things, we just give us control and we can make it all work. Well, I'm going to tell you why it doesn't work. One of my favorite stories about the then Soviet Union is the government would tell the shoe factories, you have a quota. We need you to produce a certain number of shoes. And think about it. If you were a PhD economist in the Soviet Union, you could figure out how many pair of shoes people needed, how often shoes would wear out or how often, how many children you had and how often, you probably need to buy kids new shoes every year or so, depending on how old they are, how quickly they're growing. So you could do the math, Jason, and figure out as a country, we're going to need approximately a certain number of shoes. And so, you go to all your shoe factories and you tell them, okay, you produce this many and this many, and as long as it adds up to the total, you're good. Well, what these factories would do is they figured out that they needed to use less leather or canvas or materials, expensive materials, for small size shoes than large size shoes. And so they made all their shoes in small sizes and they went to the government. They said, look, we have fulfilled our quota. You told us you wanted 1 million pair of shoes. We got you 1 million pair of shoes. The problem is, maybe you had a bunch of people who needed shoes in sizes 10, 11, and 12, but the factory was making shoes in sizes 4, 5, and 6 because it cost them less and they could pocket more of that money. It was a command economy that was completely divorced from consumer need. And so even though they could correctly predict the number of shoes they needed, and the factory could produce that number of shoes, it was pointless because you had a whole bunch of small shoes that no one was wearing and a whole bunch of people with larger feet, and they had nothing to put on them. The whole thing didn't work, and it won't ever work.
And Soviets were also bad at making cars. So like their cars broke down. I mean, there's tons of examples. Like I think they made like products that no one wanted. The consumers didn't want to buy certain types of products. So it was all the central planners deciding what types of cars should be made, what types of products, and people just didn't buy them. This certain items, the shelves were empty, and certain items, no one bought any of the product.
Yeah, that's a really good point as well. And if I remember right, I think there were multi-year waiting lists to buy a car. And even though you're right, the cars were horrible quality and broke down a lot, and it was very hard to get repair parts. It was either that or nothing. And people, they'd have to be on a waiting list for years to get the right to purchase a car.
So I want to transition now to the banking system and financial system. If the dollar stays at these levels, let's say Jerome Powell holds out, doesn't cut rates, or maybe a one token cut before the election or the end of the year, and the rest of the central banks start to cut in the G7 start to cut rates, liquidity floods in, maybe the stock market continues to rally, divorced from the real economy, which I think is bifurcated with the middle class consumer, working class. We're getting killed with stagflation, shrinkflation taxes. People who don't have a lot of variable interest rate debt, they're benefiting from this asset price inflation. Do you see a bond bear market, a lot of bond volatility, and then do you see that causing additional stress on the banking system?
So I don't know that that necessarily leads to a bond bear market here. Um, Here's my thinking on this, and let me know, maybe you have a different point of view on it. So let's say you're right. Let's say Powell holds here. And, it's my belief if he cuts, he'd probably do it after the election. And here's why. If he cuts in September, it will be too late to stimulate the economy before the election. These things take months to play their way through. But what will happen is the Fed will lose one of their best assets, which is the perception that they're not partisan. Um, I don't think it's good for Powell or the Fed to be perceived as being partisan, and cutting rates just before the election it'll be the worst of all possible worlds in that they'll look partisan without actually having an economic impact before the election. So I think if he cuts, this is of course barring any kind of major collapse over the next few months. If there's a major collapse in the next few months, he'll have no choice and have to act. If things kind of bump along as they have, and the reason they might is because the government is still throwing trillions of dollars of stimulus into the economy. If he cuts, it would probably be in December. So if we play things out the way you're talking about, let's say the ECB, the European Central Bank, the Bank of England cuts. Canada just cut. They probably won't for a while. If Japan doesn't, they've talked about raising rates. They sort of did. They raised rates, 5 basis points, something like that. They got barely over zero. Maybe it was 10 basis point. Their reference rate went from 0 to 0.1%. If all of that happens and Powell holds firm, and as of now, I think he will, then you have a situation where US Treasury yields become incrementally better, right? We may lose part of the Japan carry trade, but you may end up with some version of a carry trade or money flowing out of euros and pounds and coming here. And if that's the case, it actually could strengthen the US Treasury market. So I'm not sure it leads to a bond bear market, but again, these things get really complicated. And, as we've seen in the stock market with the good news is bad news is good news stuff over the last couple of years, sometimes you get the market responding in ways that are counterintuitive. And, they can make sense afterwards, but, you'll often see the market rally on bad economic news on the assumption that it'll force the Fed to cut. But that's my view on it. What do you think? Do you think if Powell holds firm and other central banks cut, that would lead to a bear market in US Treasuries?
I think that they are going to do whatever type of liquidity program or stuff behind the scenes, rules changes, stuffing treasuries into special purpose vehicles off balance sheet, whatever is possible. This is what I heard from a couple sources at the New York Fed in DC. They're going to do whatever they can to delay things through the election. But it sounds like we're starting to see breaking down in other central banks in the G7 emerging markets. In February, so like 4 or 5 months ago, I think like emerging markets, there was almost a sovereign debt default, and the US and China had to sit down and renegotiate some sovereign bonds with emerging markets. So I think the strong dollar, it's bad for the rest of the world. They kind of want a weaker dollar on the dollar index. And I think we're starting to see cracks now with the foreign central banks. With the Bank of Japan, did they spend $70 billion of foreign exchange reserves defending the yen and it failed?
Yeah, so hang on. We actually have a chart on that as well. Jason, I'm telling you, next week I'm gonna let you write the 5 things. You hit everything we've got. It's literally other intern Andrew Brown, who's doing a great job. Thank you, Andrew. He sent me the chart on this yesterday because we're putting it in next week's piece. But here it is. He had April 26th to May 29th, Bank of Japan intervention, $62.25 billion. And the thing that I find fascinating about it is when they intervene and they throw tens of billions of dollars at defending the yen, it typically has an effect on the foreign currency market. And those effects have lasted anywhere between 24 and 48 hours. And the reason for that is because it doesn't address the the underlying structural problem that's creating the issue, right? Ultimately, you can't have your version of the Fed funds rate at 0.05% when the rest of the world is around or above 5% and not expect your currency to slide. And so they throw their foreign currency reserves at trying to defend the yen. And because they're a large central bank, they have some weight, they have huge amounts of treasuries, right? They have the dry powder to do this, and they can push the trading around in the bond market and the currency market. But the effect only lasts for a day or two because, again, it doesn't address the underlying problem. Ultimately, Japan's problem is they've got 260% debt to GDP, which means they can't raise rates without blowing out the budget. But if they don't raise rates, we can expect the yen will continue to slide. And there were a lot of people a year and a half ago who thought, okay, sort of 149, 150 yen to the dollar, that's kind of the limit. And there were a lot of people saying that the Bank of Japan would defend that. And we did see them, raise the reference rate on their 10-year treasuries right around when the yen was hitting, 149, 150. This is about a year and a half ago. I was writing about it when I was in Thailand. And, there was this thinking that they'll defend that line. And then people thought, okay, well, they'll defend 160. 160 is the limit. That's where they'll do it. Well, guess what? I'm looking at my screen right now. I've got 160 spot 75. And so we call it 161. Well, they didn't defend that either. And ultimately, these currency interventions will not work. They'll work temporarily. But you know what, Jason? It's the same kind of thing. Imagine you and I picked some, microcap stock, and we took a few tens of thousands of dollars, and, we started to just buy the stock on the offered side. Could we push that stock up 3, 4, 5, 10% in a day? Sure, we could. But here's the question, Jason. What happens when we stop buying? What happens to the stock? Right? Did we create new value for the company? Did we make the market revalue the company? Or did we just throw money at something to move it temporarily and get a good mark?
Exactly. Now, in terms of like strengthening the currency, you mentioned Japan would, like the textbook for central bankers would be to raise interest rates. Couldn't Japan also start with their trade surpluses, start buying physical gold tonnage, but then they're going to piss off their ally in Washington, D.C. if they start buying gold tonnage because they're in the G7 then?
Yeah, I think the gold market has been fascinating. What's really interesting to me about that is a lot of the countries that are trying to either de-dollarize or reduce exposure to the dollar have been buying massive amounts of gold. In particular, China and India. Those central banks are just buying huge amounts of gold, and gold has been flowing from west to east for the last few years. And it's not clear to me why Western governments believe that their fiat currencies, like we have thousands of years of history saying all fiat goes to zero. Your fiat isn't worth anything long term, and they're just letting go of that gold. I don't know if they don't understand it or if they understand it and they're thinking, who cares? It's a 4-year election cycle. It'll be someone else's problem.
I think it's the latter, unfortunately, and I think they're planning like more totalitarian control over the next system with central bank digital currencies or a new way to do more types of inflation and fool people and tax people.
So that's one of the reasons. Unfortunately, I believe you're right. And that's one of the reasons why my second largest position right now is Bitcoin. And, there are people I talk to who are very, and I understand they're very skeptical of Bitcoin. I get it. It's new, it's different. They can't figure out the value. But a lot of these people um, own gold. And I find it really interesting that the Bitcoin community and the gold community constantly seem to be at odds with each other without realizing that they have the same underlying thesis. That if you are buying gold, you're doing it because you think the government will debase the dollar, that fiat doesn't have much value or will continually lose value. If you're buying Bitcoin, it's the same thesis, right? These two communities are constantly punching at each other, but they have the same thesis. But I was talking to somebody about this the other day, and we were talking about, the advantages of holding physical gold, owning it yourself. And I started to talk about exactly what you were talking about, which is capital controls. And what if you want to leave the country? You want to leave the country with gold. Jason, what do you think the odds are that if they start to shut the gates and not, and try to switch everybody to a digital dollar, and we end up with the government trying to grab even greater control of the economy, what do you think the odds are that you're going to get out of an airport with gold in your suitcase or in your pocket? It's
Oh,
going to
they
be
have metal detect. They have like body scanners and metal detectors. I mean, like if the TSA agent doesn't steal it, and there's tons of documented evidence of TSA agents stealing jewelry and other valuables. I mean, the government, the tax agents, customs or IRS, whichever agents are in charge of that, they're going to want to know why you're carrying so much gold or jewelry or some other type of valuable across the border.
right. And there, people have this idea that, well, it can't happen here. But not only can it, it has. Franklin Roosevelt made gold ownership by individual citizens illegal. People were told, turn in your gold or you'll go to jail. And as soon as the government had confiscated pretty much everybody's gold, what did they do? They devalued the dollar. So they said, we're going to buy your gold and give you dollars. But don't worry, the dollar has value. It's backed by gold. Well, as soon as they did that, they changed the dollar gold exchange rate. So the dollars they handed people were worth much, much less. There was a case, I think it was in California a couple of years ago, where the FBI suspected that somebody was using a safe deposit box for illegal purposes. But instead of figuring out which safe deposit box was owned by the suspected criminals, they went and they opened every safe deposit box in the place. They broke them all open. And if you had more than $5,000 of value in there, they confiscated all of that. So imagine, Jason, that you put your gold or your grandmother's jewelry or $5,000 of cash in a safe deposit box, and it's legal. You haven't done anything wrong, but somebody in the safe deposit box next to you had put money in there that was the result of illegal activity. Now imagine getting your gold, your grandmother's jewelry, your cash confiscated because somebody else broke the law. But it took these people years to recover their assets. So the government not only can confiscate your gold, they've done it. They've done it multiple times. This is something that not only can happen, it does happen. And so, you're not going to be able to leave the country with gold in your pocket or in your suitcase. And so the huge advantage of Bitcoin is if you can memorize 24 words, you can leave with your Bitcoin in your head. You don't need a physical device. You just need to be able to memorize 24 words. And my suggestion for people who are thinking, well, wait, that might be hard, is make up a song. Make up a
Well,
song that has those 24 words in it.
Well, you also have like those devices like Trezor, the other devices that can do that, or a thumb drive. So there's ways to do it without having to memorize it. And then I think there's a backup program now that goes along with the Trezor and the other devices. So there's other ways to protect yourself.
Agreed. Agreed. There are lots of ways to do it. The advantage to Bitcoin is you'll be able to leave the country with it as long as you store it properly.
But I think the main lesson here is people need to take a long-term approach that all these governments and central banks are kind of all debasing their currencies now. The other the other G7 central banks outside the Federal Reserve Bank, they're all looking at starting to cut interest rates, more liquidity. I see cracks in the banking system, maybe not the US banks yet, although I think the regional banks with the exposure to high interest consumer debt and commercial real estate are big risks. But it looks like we're starting to see cracks first in the banks outside the United States that have losses on older treasury bonds. And I think they said with this fifth largest Japanese bank, Gary, that they're going to sell $63 billion of US Treasuries and other European sovereign debt. Do you think that that's a margin call with fractional reserve banking? So that 63 billion number, that could be, the losses could be way larger than 63 billion.
You know what? I don't know the answer to that. I certainly the losses could be larger. Jason, you know the deal with this stuff. Nobody ever clears it all out at once. Right. I mean, it's basically like the cockroach theory of this, right? If you see one, there's not just one. There's never just one. Um, and so the history of these things tends to be people will do the minimum they need to do to get through the day, but they'll still keep losses on the balance sheet. And again, going back to what happened here, Silicon Valley and First Republic, those banks had, they had a year to adjust the duration on their bond portfolios. They didn't do it, right? And they knew it was happening. They just didn't deal with it. They had their fingers crossed. Maybe if we ignore it, it'll all be okay. So I don't know if it's a margin call, but I think your assumption that when they're trying to fix a problem, that they're going to fix part of the problem to make it look better right now instead of fix all of the problem. That's generally a good assumption.
Well, if I remember correctly, for Bear Stearns and Lehman Brothers, 2006 and 2007, there were cracks. So there was current events coming out. There were stories coming out like, oh, a few hedge funds that Bear Stearns was running with some mortgage-backed security, some subprime. Oh, those failed. Oh, it's only a couple hedge funds. And then, oh, subprime is contained. So basically there was like cracks every couple months for these things that there were obvious warning signs that people just ignored for a long period of time.
Yeah, Bear Stearns went from like telling everyone everything will be fine to, being sold. I think it was a $2 stock, right? Didn't they get bought for $2, something like that?
And that was
Um,
high. I think like Jamie Dimon thought it was worth less. I think that was like a token to save a little bit extra. I mean, my
yeah.
great uncle, he had like $500,000 of his retirement funds in Bear Stearns stock. So he lost like a lot of it.
Yeah, and I'm Jason, I'm so sorry to hear that, but yeah, these things they turn really quickly. And for the people listening to this who might be thinking, okay, but who cares, right? Like who cares if all the, rich guys at Bear Stearns or Lehman go under and their pension funds get wiped out? Like big deal. Okay, fair enough. I understand that. But just remember that the way these things work when the whole system is collapsing is you'll have bail-ins. And so what will happen is, when the banks fail, they may be nationalized, but they'll tell you, yeah, you have a certain amount of money in your checking account, but you can't withdraw it. And, congratulations, you're now, part of the bank. And, they'll tell you have the money, but you won't be able to get it out of the bank, in which case it's no longer your money. And, that's an important thing to remember. People think that the money you put in the bank is yours. It's effectively not. It's yours if they choose to give it back. But what can happen in these situations is you basically become effectively an unsecured creditor. And, somebody could say, oh, well, there's FDIC insurance. Yeah, sure there is. But in a scenario like this, it's in a scenario where it's JP Morgan getting bailed out, you may have FDIC insurance, but the dollars you get aren't going to be worth a whole lot.
Yeah, I agree. The FDIC, I think they only have like tens of billions of dollars. So a large enough bank at First Republic size or Silicon Valley Bank size, basically the Federal Reserve Bank has to print the money and give it to you. So it's similar to like the Ponzi scheme victims of the Madoff Ponzi scheme, how they got back their initial principal, but they didn't get any of their investment return for decades. So they were supposedly made whole, but it was like the original principal invested from decades ago.
Yeah, and that's a tough one too. And the reason the truth is I don't know what's fair in a situation like that. But the reason I could see the internal logic of it is there weren't investment returns. They had statements saying they had investment returns, but there were no investments, right? It was just a Ponzi scheme. And so, it's one thing if you have a certain amount of money and somebody says, I won't give it to you or I can't give it to you. This was a situation where the money wasn't there, but they had paper statements saying, look, you earned a return. They were told that they were lied to, but there were no returns,
Yeah, I
right?
agree.
The money hadn't been earned. They were just told it was earned. So it's
They shouldn't
one.
have the Ponzi scheme victims. A lot of them didn't even research like the investments that Madoff made. But like I think the Federal Reserve Bank just printed the money and gave it to Congress, who then gave it to the victims anyway. So it wasn't the whole thing was a mess. I mean, they shouldn't have given the ballots like that. But the majority, I've read books on this from Harry Markopoulos and others. Watched the interviews from the Madoff Ponzi scheme victims. I mean, a lot of people just said, "Oh, it's a guaranteed 9 or 10% per year return. I'm going to collect like the dividend checks and the other stuff." No one looked at any of the investments he claimed.
Yeah, my stock line on that is, there's no such thing as a sure thing in finance. I had one time, but I lost money in it. So, the other thing I would say is it wasn't that hard to figure out that there was something wrong with Madoff's operation, right? I mean, he was self-clearing. That alone was a red flag. The returns didn't make sense. And I can tell you, I one of the fund of funds that had a massive investment with Madoff. I met with them a couple of decades ago when I was raising money for a hedge fund I was running. And, we started with an okay amount of capital, but it wasn't huge. And, so we met with the people at this fund of funds. And, they were very snotty about saying no to us. They said, look, you guys seem very smart and, you have great pedigrees and I'm sure your returns will be good. But, we do a ton of work. We do so much research and, you're so small. We couldn't invest enough. Basically, it's not worth it for us to invest with you because we'd have to do so much research. They were very full of themselves. Yeah,
Oh.
really snotty about it. And then the thing that killed the firm was it turned out they had 60% of their money with Madoff. And I'm thinking to myself, what are you guys kidding me? 30 minutes of half-assed due diligence would have uncovered the fact that there was something wrong here. So these same people saying it's not worth it for us to have to do all of our massive amounts of research and due diligence. You guys are too small. You're not important enough for us to even think about investing. They had 60% of their money with a guy where 30 minutes of dedicated work would have uncovered the fact that something was really, really wrong and should have caused the most senior people of the firm to say, we need to do a full on deep dive here and some sort of forensic audit and figure out this is okay or get our money out.
Well, I interviewed the former lawyer for Madoff, Helen Davis Chapman, who was also a victim of the Madoff fraud. And Madoff called her on the phone and he said that JP Morgan knew from like the first or second day that he started managing money that the whole thing was a scam. So, in my personal opinion, like researching this, reading books and stuff, I think most of the institutional investors knew it was a scam. Madoff was giving them like commissions and stuff like that. He was making it profitable for them to feed him more funds. So everyone knew it was a scam. It was just very profitable for them to participate in the scam. I think most of the institutional investors knew.
Yeah, I think that's a really solid analysis of the situation. To me, compounding the fraud of taking fees on money that you're investing in nonsense that to be nonsense is horrible. But adding the hubris of saying to people, we do so much work, and it was just the hubris of the situation that, I found ridiculous. And I'm not a big fan of Schadenfreude. I'm not a big fan of cheering for people to fail, or being happy at the misfortune of others. It's a bad way to go through life. But Jason, I'm going to confess, when I saw that they went under because they had 60% of their assets with Madoff, I did crack a little bit of a smile. I'm not proud of it, but I'm confessing, I gave into those negative feelings for just a few minutes there.
Well, isn't that how a lot of the Wall Street banks, like they fleece their own customers? I mean, there was like tons of class action lawsuits for like a lot of the Wall Street investment banks, Morgan Stanley and others charging their customers for custodian fees on physical gold and silver for storage fees, and the metal's not there. So there's tons of examples of this, whether it's bond funds or stock mutual funds. I mean, the institutional investors, a lot of Wall Street investment banks have robbed their clients. It's mostly what commissions and excess fees.
Yeah, I think there's something to that. I had a friend years ago who went to one of those big firms and she had, about $500,000 of assets, which is, first of all, good for her, for being able to save and invest. And, she did a good job and that's terrific. But in that particular playing field, it's a small amount of money, right? That like, Morgan Stanley's private wealth is not taking on people with $500,000. And what they ended up doing was I think they put her in something like 24 different mutual funds, which is insane, especially given the number of cross holdings. And basically, if you're going to own 24 mutual funds, you basically own like a world stock index. You pretty much own everything. And what what she was paying for that were two levels of fees. She was paying fees to, 24 different fund companies or 24 different funds, and then paying, the investment bank, a 1% a year fee on top of that. So basically, she could have replicated the entire portfolio by buying, like the Morgan Stanley World Stock Index. And instead of doing that, she was paying two levels of fees. And it was technically legal, but highly unethical. And it was abuse of a customer. And they were treating her $500,000 account as a way to skim off huge amounts of fees. I don't think everybody in the business is dishonest. I just think that in situations like this, the incentives are often not very good, and the bad stories make their way out. Nobody is writing.
Well,
Under,
a lot of those mutual funds and active management, they're going the way of the dinosaur or the dodo bird the last 10 or 15 years, right? Most of the savings are going into index funds now.
yeah, and I think there's something to that, and that also is creating opportunities, and it's also creating distortions in the market. And we're seeing that with, a limited number of tech stocks, which you talked about before, where the performance of those companies has absolutely been spectacular. Yet many of them have had terrific fundamental performance, but the issue is that the larger you are, the bigger a percentage of the index you are. And so that means more investors have to buy more, especially in the index funds. If you're buying the index fund every time, Apple stock goes up, those index funds have to reweight, and they have to own a larger share of Apple stock, and the new money that comes in gets thrown into that. And this is a company with a dedicated customer base and a terrific ecosystem, but their unit sales have been down a lot, for what is it now, 5-6 quarters in a row, something like that.
And the
you know
market cap's up by a trillion in the last 6 weeks.
right. Yeah, I mean that's a problem. You start adding $1 trillion of market cap, but you're selling fewer units. That at some point you're dealing with market distortion, and part of it is the trend toward passive indexing, and part of it were the things you were talking about earlier in this conversation, where money is just flowing out of certain places, and right or wrong, in times of world stress and political stress, the United States and our capital markets and the dollar are sort of still viewed as the go-to place to go for safety. And so, my view on it is you're better off owning, individual growth stocks and a whole bunch of dollar alternatives that we talked about before. But, I understand why it's happening. I just think also understand why it makes sense for people to trend toward passive investing, but it is leading to some distortions in the market that will have to get sorted out at one point or another. And I don't know when that's going to happen.
Okay, last question before I let you go. So I know in past interviews and your writings, you've been writing a lot about commodities. You normally want to hold exposure to the physical commodity like a gold trust or the uranium trust instead. Do you think that the producers of the commodity, so uranium miners, gold miners, copper miners versus their commodity price, are they going to continue to underperform for the reasons of like the commodity business, the profit margins, that there's inflation producing the commodities? Or do you think that these companies are going to start to perform at certain increase, or excuse me, that they're going to start performing at levels commensurate with the commodity price rising, the underlying commodity price?
I mean, long term, the performance of the mining stocks has to approximate the performance of the underlying commodity. What we've seen, as you know, over the past couple of years, is the underlying physical commodities in general have far outperformed the mining stocks. The reason I like to own the physical, and I know you and we've discussed and debated this, and we differ on it, and I think your reasoning on owning the miners is sound. It's really good. I know you've done great research on this, and you've correctly pointed out that in general, when the underlying commodity goes up, the miners will go up more. You have leverage, you have operating leverage, and I completely agree with you that that's how these things tend to go. But you're taking a whole bunch of other risk. And so, one of the best examples I can give, and I get a lot of questions about this. One of my largest positions, right now, my third largest position is uranium. And a lot of people say, well, why not just own Cameco, the huge Canadian producer? And it's an excellent company. And there are all kinds of issues with that, right? One, you have labor relations, you have operating issues, you have permitting, you have the decisions made to, whether you can open new mines, how long it takes you to open new mines, you have wage issues, right? I mean, it's hard to get physical labor right now. And so labor costs are going up. And it's gotten so nutty that even at a time when uranium prices have skyrocketed over the last few years, and it's been a hugely profitable position for deep knowledge investing subscribers, um, Cameco is intentionally underproducing. And so, they have contracts with their customers to supply a certain amount of uranium, and they're mining less than that. And even though the price that they have on their long-term contracts is below the current spot price of uranium, they're continuing to engage in the same underproduction. And so you have this nutty situation where higher uranium prices, now long term, it'll be great for Cameco. But right now, today, it's actually creating a problem for them because they have long-term supply contracts, and the spot price of uranium has gone above the um, uh, the the price of the physical, right? Sorry, the spot price has gone above their contract price, and so they're buying in the spot market to supply their contracts, and they're losing money on this. So higher uranium prices have become a cost for Cameco. Again, it won't be like that forever. At some point, it'll turn around and newer contracts will adjust. But right now, they're doing some of their business at a loss and choosing not to mine more. And as long as situations like that exist, I prefer not to have exposure to that and figure out how much they're going to produce and how much they're going to lose buying in the spot market. I'd rather just own the spot uranium and have exposure to my thesis. And, if you're right on this, and I think your reasoning is sound, I'll be giving up potentially a certain amount of upside, but I also won't have to track a whole bunch of nonsense that may not make sense to me. And I'll just get exposure to my investment thesis, which is nuclear is going to be there's going to be a huge increase in nuclear. There just has to be for us to have the kind of energy rich future that we want. And, people are saying, well, we want to do it without carbon. Well, if that's the case, nuclear is the answer. And that demand is coming on before supply. And so I really just want exposure to that particular thesis. I think long term you're going to be proven right, but because I don't know when that's going to be, I'm just sticking to the bet that I have for now. Does that make sense?
Yeah. Also, let me add that I actually don't own gold mining stocks. I own the royalty company. So I get exposure. I get more free cash flow, better profit margins, more diversification without the capex risk. So there is some risk. Obviously, like Franco-Nevada had a large gold stream come offline, but they're not going to go bankrupt. And they still have a lot of other streams and royalties. So the shares went down, I think, about 30%, but there was risk reward. There was a good buying opportunity there. You mentioned Cameco. I mean, like, I think as a trade, maybe a short-term swing trade for a couple of years when it was at $11 to $15 a share was a trade. But I 100% agree with you that from an operating business, you cannot buy and hold a mining company for three, 5, 10 years and just not check it in your portfolio, because then you could be in a situation like in Canada in the Yukon where you think you own a mine stock like Victoria Gold and this heap leach pad is everything's fine. And then all of a sudden you turn on the news and there's a crash at the mine. The heap leach pad broke and you don't know exactly what's going on. You see the articles and oh my God, they own one mine and then the company may be up for sale soon or going bankrupt.
Yeah, it's definitely an issue. And the other thing is people in general have a tendency to overestimate their reserves. It's just a natural tendency. And so if you own the mining company and they've overestimated the reserves, that becomes your problem. If you own the underlying commodity and the mining companies have overestimated their reserves, that is to your benefit.
Well, the royalty and streaming companies is just different. You're buying like a royalty on the land. So the mining company, if they, or the junior or the explorer, if they drill off the land, the royalty and streaming company aren't paying all that extra capex for the drilling. And so if they find a mine, you're just collecting like a royalty, a 2% royalty per year on the cash flows of the mine. They're not paying any additional capex. So like the business model, I think, over the long period of time, it's very efficient and it works. It's just about the valuations. A lot of people say that like the royalty and streaming companies are too expensive versus the mining stocks.
Yeah, I think there's something to that. And, I'm not averse to owning that. Um, one of the companies I've owned for a few years now with huge profits is Texas Pacific Land, TPL is the ticker. And that's very much along the lines of your thesis, which is, it's a royalty company. And that's worked out really well.
Yeah, there's quite a few oil and natural gas royalties. I think there was a merger, consolidation, mergers and acquisition for the royalty for oil and natural gas. Franco-Nevada actually just bought about 150 million of cheap natural gas royalties in the Haynesville Shale area in Louisiana. I think in November, right next to the liquefied natural gas export facility. So they got all those cheap from companies that had financial problems.
Oh, God. Wow. Well, good timing for them.
Well, they do astute things in general. They do a lot of smart deals. I mean, that's why the company's been around since the 1970s. The one on the Panamanian mine though, they didn't get protection in that, so the stock got hammered by 34%. I think the bad news is priced in. Think they're going to do some smart growth. I've owned Wheaton Precious Metals since it was like $11 to $15 a share, so I've owned it for over a decade, and it's up like almost 5x.
Good for you. That's phenomenal. The people who will own these things long term, um, and have the patience for that, I think that's absolutely a great way to invest.
Well, I mean, the business model works, right? So they're getting free cash flow and profit margins, and like Warren Buffett or a value investor, they're reinvesting it into more growth, and they're not doing anything super sophisticated, which is where you get in trouble if you're a Wall Street banker or a hedge fund now.
Yeah, there's nothing wrong with having a simple business, easily understood, simple capital structure, and you're right. Like people on my side of the business can easily fall in love with complexity. And, one of my first jobs in the buy side, I did risk arbitrage for a while, but then I did special situations, event-driven investing. And so, constantly these complicated things and doing pro formas and valuing, this business is this, and, this is going to be spun off and this is going to be restructured. And it was fun. We, build all these complicated models and make a lot of money from it. But we do have a tendency in my part of the business to fall in love with complexity. You get to do all this, fun modeling and pro forma analysis. But long term, there are certain advantages to having an easily understood business model. I think we just like the complexity of it.
Yeah, I agree. Easy business models, efficient, easy to understand. You can't hide things. Wall Street's obsessed with these leveraged bonds, leveraged short volatility trade, all these leveraged bets that they made, the stuff with the repo market and borrowing that blew up a lot of hedge funds and banks. And now, in April, there was an article in Bloomberg about too big to fail hedge funds, Gary, with leveraged bond trades.
Yeah. So apparently, there's very little difference between a too big to fail hedge fund and a too big to fail bank. Right? We do not. We should stop pretending. Every time I hear people complain about capitalism, I think not allowing failure, too big to fail, government partnerships, government bailouts. This is the opposite of capitalism. This is cronyism. It needs to stop. And I understand why people are angry, and I agree with them on this stuff.
Oh yeah, I 100% agree, and I think that's why Ken Griffin. The rumors are he's trying to get into politics or get a Treasury secretary position so he can get one of those tax-free deals on his equity position, like Henry Paulson did from Goldman Sachs to U.S. Treasury secretary.
That's interesting. I don't know his motivation. I just sort of assume when somebody's made enough money like that, they kind of like the prestige and power of having one of these positions with, a big nameplate on the door where everybody knows who you are.
Well, supposedly Hank Paulson, to get that Treasury secretary position as part of the negotiations, he got $500 million of his capital gains taxes waived.
Wow. Well, Jason, you and I are in the wrong business. Instead of talking about this stuff, we should be cutting deals to get cushy government jobs for ourselves.
Yeah, we should be hedge fund managers like Nancy Pelosi, where she can make like $20 million in 12 months.
Yeah, her trading instincts are outstanding. That and having access to inside information is probably really useful. By the way, I would love to see that rule lost. The fact is, it's illegal for us to trade in inside information, but Congress is allowed to. It's actually legal. That's why you never see these people being prosecuted for it. It's not against the law. I would love to see that change.
Amen. I don't think it will change because that's asking the foxes to correctly guard the hen house.
Right. I mean, can you imagine going to the, the mafia and saying to them, "Hey guys, nice business you have here, but we'd like you to cut your own profits." Yeah. So no worries. I'm going to leave. You guys take a vote yourselves. Let us know what you decide to do.
Same thing with term limits, right? So, like, is Congress going to actually vote for themselves to have strict term limits so they leave Congress and leave DC Metro and lobbying and all the other perks that come from here?
So I'm with you on that. Although this is a situation where we as voters shouldn't just blame the politicians. Remember, we have the power to enact term limits ourselves. Um, we choose not to do it. They choose not to do it. Um, if you want your congressperson replaced, then primary them.
I mean, it sounds good in theory, but like there's so much lobbying dollars backing certain candidates. I mean, like these are not free and fair elections. Let's be honest here. I mean, there's like tons of people in Congress that set up like charities and stuff like that, and there's campaign contributions going into their charities. I mean, there's so many ways around the laws. It's just sad.
Yeah, that is true as well. I think you're right. I'm just pointing out that we as voters could make a better effort to enact term limits ourselves. And Jason, let's be honest about this. People who talk about term limits typically want the elder statesman of the other party replaced, right? When Democrats in California talk about term limits, they're not thinking about Nancy Pelosi and Maxine Waters, right? And it's the same on the Republican side. Republicans will talk about term limits, but but Mitch McConnell keeps getting elected, right? The Kentucky isn't voting him out. So, I think this is one of those situations where I agree with you. Congress does not have an incentive to have the integrity that George Washington did when he chose to step down after two terms and advised that others follow his lead. Um, I mean, what a great man to step down from power voluntarily because he was afraid of the negative impact of holding that power too long. That's Lord of the Rings kind of self-control there. He had the ring of power and handed it to someone else. Um, that takes a huge amount of will and integrity. And, we're not going to see that in Washington, but we as voters, we could primary these people. We don't.
Yeah, I was
So
going to say.
it's not just them.
Well, I was going to say, unfortunately, things are headed in the wrong direction here. I could just tell you. I mean, they're already like I've heard a lot of stuff off the record. I mean, they're already discussing a new government-sponsored enterprise to stick. I heard like Resolution Trust Finance Corporation or kind of a bad bank to stick like all the commercial real estate toxic garbage in after the November elections for next year. So it's already being discussed. I mean, I don't know like when they'll do it, but they're already talking about it. They know it's bad.
Yeah, unfortunately, I think whoever wins the November election is going to be handed a real mess. Um, I don't know that the prize for winning this election is so good. I think the prize for winning this election is you're going to be handed a gigantic amount of problems. And, everybody in Washington, this is a bipartisan problem. They've chosen okay, but we'll just double down and, kick a bigger can down the road. And next time we'll kick an even bigger can down the road. That works until it doesn't.
Well, and now we have the supply and demand issue in US Treasuries because fiscal 2025, they're projecting what, $8 trillion of spending, and that's not even counting a high interest rate on the national debt.
Yeah, we saw last week the CBO, the Congressional Budget Office, just increased their estimate for our deficits and debt. And, so that got some reporting. I'm thinking to myself, these estimates only go in one direction. They always go in one direction. They never come down.
Well, and now we're back to fiat currencies where I don't think deflation is going to be allowed for a long period of time because of the way things work with both political parties here in DC, Wall Street, large corporations, deflation and bankruptcies. That means the large corporations aren't doing well. The stock market's crashing. The government doesn't get to tax. Their tax receipts could collapse. And then the Fed, historically since 2008, the Fed has had to step in and fund government with quantitative easing and expand its balance sheet.
So that's true. I would add to that that inflation is great for wealthy people in general, terrible for poor people. The opposite is true. Deflation is fantastic for poor people, not so great for wealthy people. Um, and so, who's in Washington? Who's making the rules? Who's lobbying them? It's a skewed system. And the amazing thing is they talk about inflation as if it's to the advantage of the little guy or the lower classes or people who are less well off financially. But it's not. It's a disaster for these people. These policies that they're pursuing, supposedly in the name of income equality and helping the little guy, are absolutely making things worse. They're achieving the exact opposite of the effect that they claim it'll have.
Oh yeah, I 100% agree. It's very similar to what F.A. Hayek wrote about. We're far along the road to neo-serfdom or neo-feudalism because people my age, and I'm in my early 40s, people my age or younger, we just don't have the savings or the high income to go out and buy a lot of assets to benefit from the asset price inflation that's occurring for the last few decades.
Right. Yeah. And, I look at this and, in the fourth quarter of 2021, I saw what was going to happen with interest rates. And so I refinanced the mortgage on my house. Right. And I took out a big mortgage. And so when the dollar depreciates, well, guess what? I make the same monthly payment to the mortgage holder, to the bank. Um, but the value of those dollars that I hand over every month goes down. And so, that's what we're talking about when we say inflation benefits people who are well off. If you're in a position to buy hard assets, whether it's gold, Bitcoin, oil, real estate, housing, whatever it is, and you can finance that through debt because you have the credit rating to support it, the dollar price of your assets will go up. The dollar value of your liabilities, the debt that you owe, pardon me, will go down. And so, they claim we're going to enact these policies to help these poor people. That's not what's happening. That is a dead giveaway that they're about to do something horrible to poor people. Um, and these, and a lot of this stuff, I can't tell if these people are economically illiterate and just don't understand the way things work, or if they know what they're doing and are saying, well, it sounds good and we can hurt people and steal money, so let's go for it. I can't tell if it's incompetence or malevolence, but either way,
Corruption.
it's wrong. What's
Corruption,
that?
moral bankruptcy. They're stealing as much as it. This is very similar. You study financial history, British Empire, Roman Empire, Chinese dynasties, Mongolian Empire. The things became so corrupt and bloated with the bureaucracy and Congress or the ministers. They were stealing as much as they can with currency debasement and taxes before the system collapsed.
Yeah. We may be right around the Caligula part of the show here.
And smart people like you, they refinanced their debt when interest rates went down. So did large corporations. Unfortunately, Gary, the U.S. federal government did not. And it's looking like we're going to see a supply and demand issue coming up in U.S. Treasuries because I don't see anyone in D.C. who's key political position, whether it's the White House, Congress, key people in the Senate or House of Representatives. They don't really seem interested in cutting spending. I hear like no one talking about actual spending cuts.
That's one thing that we've written about a lot lately. Um, Everybody gets wound up over the election, and I understand. It's there are issues that are important, but from an economic point of view, nobody is going to cut spending. Nobody's even thinking about it. Neither party's going to do it. And so, the thing that I've said to people is we cannot vote our way out of this problem. There is nobody you can vote for that is going to cut spending in the way that it needs to be cut. Actually, forget there's no one you can vote for that's going to cut spending at all. It's simply not going to happen. We have a bipartisan addiction to spending, and the way that our government has chosen to finance its debt, and you and I might have spoken about this before, um, is through inflation. And here's why that matters. Jason, let's go back, maybe 50 years ago to when our parents would sit around the table and you'd have to write a check for your taxes at the end of the year. And what that did was it forced a conversation about the proper size and scope of the government. Nobody likes writing a check for taxes, but if people felt like the amount that they were writing was reasonable for the privilege of living in this country and for the benefits that they got and for having a certain kind of society and the spending were justified, they'd say, okay, I don't like writing this big check for taxes, but I feel like it's worth it and I'm on board. If, on the other hand, they were writing a giant check for taxes and they felt like it wasn't worth it, the pain of having to write that check would force conversations and it would cause people to vote for, politicians who would say, yeah, we're going to cut this program or that program. It forced real conversations. Now what we have is a situation where nobody pays for anything and the government is just financing everything with debt and the treasury is monetizing it and it's leading to debasement of the currency. And so people have this nebulous sense that something's wrong but can't quite put their finger on it. They're told we're living in this wonderful economy and your wages went up, but somehow it's harder and harder for most people to make ends meet every month or every quarter. Their grocery bills are up a whole lot more than 1 or 2%, despite what the CPI says. And these are huge problems for people. And the issue with it is our government has now decided we can afford guns, butter, bread, circuses, waste, doesn't matter. We'll fund everyone and everything, and it doesn't matter. And we'll just keep writing checks and ignoring the fact that there's no money in the bank account. And what Congress does is instead of saying, okay, look, everybody, yeah, we debased the currency. That's why things are really expensive. They blame everybody but themselves. They blame, Vladimir Putin and they blame supply chain issues and they blame COVID and they
It's the
blame
greedy grocery stores. Yeah, they're raising
right.
their profit. They're raising their prices and doing some shrink. It's the greedy grocery stores who, by the way, have like a 1% growth. Their gross margins are insanely low. If they didn't raise
Yeah.
their prices, they might be bankrupt.
That's exactly it, right? And people don't realize like they go to the grocery store and it's expensive and they blame the grocery store. But if you take a look, you're exactly right. At grocery store margins, they are tiny. It's a huge problem. And so, the issue here, Jason, you and I have had the luxury and the interest in studying these things for decades. But most people don't come home from work and say, I'm going to read about finance and economics and the markets and figure out how all this works. And you know what? I understand that. Imagine, you work all day, you 8, 9, 10 hour day at work, and maybe you commute an hour or two each day. And people come home and they just want a little time with their family and they want to play with their kids and, maybe go for a walk with their spouse or the dog, exercise a little bit, you know, do some laundry and crawl into bed and get some sleep. It's really hard to blame people who are just trying to live their life and raise a family for not spending all their free time trying to figure out how the economy works and how finance works. Um, I don't blame them for that, but it is an issue when Congress can blame everybody but themselves, and most people don't understand what's happening. And Congress is taking advantage of the fact that most people are too busy to read about this stuff and really try to understand it. And most people are not well informed about how these things work. And that's why I think, your show in particular is so important, where you take on all of these important issues that affect people's lives. And it's a great name, right? Wall Street for Main Street. I think you do a phenomenal job of helping people understand the world that we're living in. And if they give you an hour at a time, they'll understand the way these things work at a level that Congress and everyone in Washington is hoping that they won't. So thanks for doing what you're doing.
I really appreciate that, Gary. You didn't need to do that. I thank you so much. Please tell my listeners more about deep knowledge investing. I've kept you for over an hour. This discussion was great, though. Hopefully, our listeners get a lot out of it.
Well, thanks so much, Jason. I really appreciate you inviting me. I'm always happy to come on and talk with you. I love our chats. For people who are interested, I run Deep Knowledge Investing. We're at deepknowledgeinvesting.com, or look me up on Twitter or X at Gary_Brode, Brode. We work with hedge funds, family offices, registered investment advisors, and individuals. I have some subscribers who have, a few tens of thousands of dollars in a Schwab account or a Robinhood account or an E-Trade account. And what we do is we help people get better returns in the stock market through a limited number of high return, high probability individual stock picks. That's worked out really well. We've had more picks that have gone up 100% or more than we've had picks that have lost money. So our subscribers and clients have done really well. And then we also, like you, Jason, help people understand the macro environment and we help them hedge, which is a fancy way of saying, okay, look, we've just spent an hour talking about a lot of bad things in the economy and in the dollar. There are a lot of bad things coming. What do you do? And, we help people devise strategies that will protect them from all the negative stuff you and I spent the last hour or so talking about. We help protect people from that and even to benefit from it and to be in a position to make money from the things that are currently making a large part of the country miserable. So, that's it. If you guys are interested in better investment returns or feel like we can help you, please feel free to reach out. Either go to the website and send me an email from there or sign up from there, or you can reach out at ir@deepknowledgeinvesting.com. That IR stands for investor relations. So ir@deepknowledgeinvesting.com. I read everything that comes to that address. So if any of you send me something, I will read it, be happy to answer any questions.
And last time you said there was a coupon code, right? If people wanted a free trial or a discount for a first month or two of membership?
Yes. Yeah. Jason, thank you so much for reminding me. We still have the same coupon code for you. Do you remember the code on it? If not, I'll look it up and make sure you have it.
It was in the information description section of our last interview, so I'll look it up after the recording is done.
All right, good. Sorry for not having it in front of me, but I'll double check to make sure that coupon code is accurate and still active. And if anybody tries to use it and you have any problems with it, just email me at ir@deepknowledgeinvesting.com. I will make sure that the coupon works and that you get in at the price that was promised.